Episode of the MD Investor, the channel where we talk about personal finance and breaking the cycle of generational poverty. If this is your first time, welcome. If you're a regular, welcome back. Today we're going to talk about the Amazon stock split, as you can see here on the screen. So March 9th, Amazon's board of directors agreed to a 20-to-1 stock split and a $10 billion buyback. Let's first talk about the stock split. So basically, what is a stock split? Basically, a stock split is when a company decides to divide its share price to make it a little smaller. Example would be if you have a company and the stock is worth $100 and they do a 2-to-1 stock split, they take $100 divided by 2, and now each share would be worth $50. It creates no value. There's no change in the intrinsic value of the company. So if you have one share at $100, it's worth the same as 2 shares at $50. The total value is both $100. So it makes no change. So why would they do that? Psychology, right? Amazon, at the time I'm recording this, is trading for about $3,000. That's a lot of money. $3,000 to buy one share of a stock, that's a lot of money. And the psychology of that hurdle, financial hurdle, to get over is a lot for a lot of people. So they will stay on the sideline and they will not be able to participate in the growth, the revenue, the profits of a company like Amazon. You now do a 20-to-1 stock split, and now each share is worth $150. Sounds a little more attainable, right? So, but it's not going to create any real value. But because the companies know that $150, people will come in and buy a share, so they probably get new shareholders, people who were not able to buy at the higher price will not come in and buy, right? They may end up buying 20 shares with a total value the same, and you're like, how did they do that? Psychology. Now I'll be able to buy, maybe every week I'll buy 2 shares. Eventually you'll get up to that number. So that's basically what a stock split is. And the reason why they do it is basically psychology, right? The lower price attracts more people. A lot of companies did it. Do it. Apple actually did it maybe a year ago. They had a 4-to-1 stock split. They were trading at about $400. Did a 4-to-1 split. $400 divided by 4, and then each share was about $100. Of course, it has since went up. Next question you may ask is, should I buy Amazon now, before the stock split, or after the stock split? The stock split was announced March 9th. It's going to take effect, I think, May 27th. And will begin trading on the split-adjusted basis on June 7th, right? So that's a couple of dates to remember. Should I buy it before or after? Because of the anticipation of the stock split coming, a lot of people are very excited, right? The stock market basically is an emotional thing. People are very excited, right? So the Amazon price is going to go up. If you wait till after the stock split, you may miss that increase, that rise. So a lot of people are buying now, which is probably not a bad idea. If you buy now, you get it for $3,000. But if you wait till the stock split in May or so, it may be $4,000. Who knows? Okay, the next thing I want to hit on is the buyback. Actually, before we get to buyback, so you said that Amazon has split several times in the past. This is the first split since 1999, right? So it's been over 20 years. And it's the fourth split since the IPO in 1997. Okay. The other thing here is that the company also said its board has authorized Amazon to buy back up to $10 billion worth of shares. So what is a share buyback? Essentially, companies issue shares, right? So shareholders like us can buy them on the stock exchange. That's how they get money. Any shares that the company owns are not included in the valuation, right? So the only shares that are included in the valuation are the valuation of the company or the price of the company, or what they call outstanding shares. Shares outstanding. The shares outstanding are the shares that are out there on the public markets for people like you and me to buy. Outstanding shares. Sometimes a company will buy their own shares. And you're like, why would they do that? Companies will buy their own shares for several reasons. One of the reasons why a company might buy back their own shares is that the price is attractive, right? The price is attractive, right? And they see that they can buy back their own shares, take them off the public market, and what that does is that there'll be fewer shares left outstanding. And since it creates no value, it's gonna the price of the outstanding shares will then go up. That's a way to unlock shareholder value, right? So, for example, Amazon have about, I think, 510 million shares outstanding. When the board of directors approves $10 billion buyback, and they buy back $10 billion worth of Amazon stock, those shares are now off the public market. Then what remains is a fewer amount. That means those shares automatically will go up in value. Okay? So share buyback is a way for companies to increase the value of the remaining shares. And that's one of the main reasons why they do it. Okay? So yeah, this is the MD Investor guy that we talk about things like this on a weekly basis, and let's try to increase our financial IQ so we can break the cycle of generational poverty. We realized that we kept waiting and we kept waiting for Superman to come and save us financially, and Superman never came. So we decided we have to take matters into our own hands. If there's people out there you think could benefit, let them know about the MD Investor. On YouTube, it's MD Investor. On Instagram, it's MD Investor1. And I will see you on the next one.